We're going to talk today about what goes into spot prices, what goes into premiums for gold and silver, right? And also, I think Alexis had a couple of questions about particular situations that she's observed in the last year or two that she's a little bit unclear about. Do I have that about right?
That's right. Well, I mean, you basically just took it from my mouth. I'm questioning how spot prices are calculated.
Okay.
I really don't know.
That's a fair question. I think most people in the stacking community probably already pretty aware, or at least have an intuitive understanding of this. But yeah, there are a lot of markets out there. In the United States, there's the COMEX, the Chicago Mercantile Exchange, and there's also the NYMEX, although that's to a lesser extent.
New York?
Yeah, New York. And then in Europe, there's LBMA, the London Bullion Metals, London Bullion Markets Association. Yeah, and they have a what they call a price fix that they put in, or they fix the price. It's basically kind of their spot, but it's done in association with a bunch of private dealers as well. And I don't think they're publicly traded the same way. There's the Globex, which is traded. NYMEX, COMEX, Globex, they're all exchanges. They're traded. You can have an account with a futures broker that'll let you trade futures, and you can trade those. Shanghai as well. There's also a Shanghai index or a Shanghai exchange, right? So all these exchanges, you can buy or sell contracts on those exchanges. With the LBMA, you can also buy and sell promises to deliver, right? Deliver or buy gold or silver products. The COMEX has it at 100 ounce bars, big bars, right? 100 ounce bars of gold, 400 ounce bars of gold. They have two separate contracts for these. They also have contracts for 1,000 ounce silver bars, and I think it's could be 4, but I think it's 5,000 ounce silver bars as well, right?
The futures contracts for these are
the futures contracts, yeah. So those are contracts that agree to buy a specific amount of gold or silver or sell at a specific date. And all the exchanges, they also have delivery terms and conditions that you agree to. You might have to pay fees for it. Technically, I think unless you pay additional fees, you have to show up to the COMEX exchange in person, come collect, or send an agent to go collect your bullion off the market. That's how you take delivery. Market participants in the COMEX include hedge funds, traders of all kinds, including retail traders, wholesale traders, or I'm calling productional traders, professional traders, right? It includes manufacturers who are pulling supply. It includes producers who are anticipating producing a certain amount of gold or silver, but they want to get a fixed price determined in advance, right? That's ultimately how all futures markets were ultimately formed. That's a reason why. It's because producers needed something so that they can guarantee income stream in the face of volatile prices, right? So, a miner wants to guarantee they'll get at least, let's say, $20 an ounce for silver or $25 an ounce for silver. Then they'll go out and sell a bunch of contracts into the market, right? And speculators will buy those, right? And so that'll guarantee that there'll be a certain income for the miner, even if the prices go down a lot, right? So it's a way of what they call hedging production, right? Big wholesalers and perhaps even big retailers of gold and silver, if they have inventory, right? They'll hedge against their inventory stocks. Let's say you're a retail bullion dealer and you have 1,000 ounces of gold, right? Well, what happens if you bought those 1,000 ounces of gold at, let's say, $2,000 an ounce, and then for some reason overnight the price of gold went down to $1,000 an ounce, or let's say over a month, right? You're going to lose a lot of money on that. But if you have a couple of contracts that you used to hedge your 1,000 ounce inventory of gold, right, then if those are in place, they can protect you against the loss, right? Mm-hmm. And you do that by selling contracts into the market, and then buying back those contracts in the future if you need to. Or you can even sell your metals if they're good delivery metals. You can send them to the exchange, and you can clear out that way. So it's just a way of hedging your inventory, hedging your production, right? That's how a lot of people use it in the gold bullion business, or a lot of entities. And then again, manufacturers, like we covered, if you're making photovoltaic cells, if you're using silver and less so in photography applications, both gold and silver if you're making jewelry, cell phones, right? They use small amounts of gold and silver as well, electric vehicles. So a lot of things rely on gold and silver for industrial uses as well, or for jewelry production. And they, again, are also either taking it off the market or they're hedging their inventory stocks, right? And that's in addition to trading and speculating and all the other kind of financial activities we see with gold and silver, right?
And so that sets the price.
All those participants in the market in aggregate are setting the price. And there's one I forgot to mention that's really important that I think recently has been putting a floor under the gold price. And people have talked about it and written about it. The stacking community members are probably aware of it. I don't think it's news to them. But central banks are going out and they're buying a significant amount of gold quantity. China admitted to buying, I think, 300 or 400 tons in the fourth quarter of 2022. That's a lot. Mm-hmm. They only claim or admit to having, I think, 4,000 or 6,000 or maybe 8,000. I think it's 4,000 or 6,000 tons. In reality, some people believe they might have as much as 24,000 tons. But for them to go out and buy 400 tons or 300 tons in one quarter, that's a lot of buying, right? Yeah. And I think that's putting a floor under the price because they're probably pulling that off the Shanghai market, right? And of course, all these markets being international markets, they're often very quickly arbitraged with each other. So you'll see the price set in Shanghai. Let's say the Bank of China or the Chinese government is buying a lot of gold off of Shanghai. They're doing it in probably small amounts, like tens or hundreds of contracts at a time over periods of time. And so there's an arbitrage opportunity there. So if the price of the Shanghai futures contract, let's say it goes up to like 2,100, just to give a really extreme example, then what you can do is you can go buy gold in the London market or else in the New York market or Chicago market, and then you can sell it to that market, right? Or make a promise to sell it to that market. So there's arbitrage opportunities, and through arbitrage, all the prices of gold and silver are basically standardized throughout the entire world, right?
So how is premium calculated?
Oh yeah, and that's spot price, by the way.
Yeah. Right.
All right. So premium reflects a lot of additional factors. So you and I and most people watching this video are not in the market to go around buying 100 ounce bars of gold or 400 ounce bars of gold or 1,000 ounce bars of silver or 4,000 ounce bars of silver. Right. Not on a regular basis. What we're buying and what a lot of other entities might be buying, even kind of smaller jewelry manufacturers, independent artisans maybe, they're buying lesser or smaller quantities of gold and silver. Or they want smaller quantities of gold and silver in a different form than a bar. Maybe they want a minted coin. Maybe they want a piece of jewelry, right? Like bullion grade jewelry, for example. Or maybe they want customized silver, right? A lot of people, we were at a shop just the other week where they had a bunch of just interesting silver poured out. I think one piece had tombstone on it that you kind of thought was cool. And, just silver ice cream cones, as Yankee Stacking would call them. So part of it is the demand is different. There's divisibility. So you want to get just a 1 ounce coin of gold rather than a 100 ounce bar. And there's a cost. You have to melt down that bar. It has to be, minted by the mint or poured out or stamped by the refinery, which, stamps require a stamped metal. It requires a several ton press to go down. And that press requires energy to use. And, you have to pay the employees in the mint and the refinery. So the manufacturing costs and dividing large bars of refined pure gold and silver into smaller amounts, that adds to the premium intrinsically, and it will always be a factor, right? So transportation, that's another factor. It's a lot easier to transport, 4,000 ounce bars of silver than it is to transport 4,000 ounces in coin and round form. You have to have packaging, that they have to be put into the packaging. That packaging might have to be individually sealed. It has to be moved around instead of just being shipped from maybe a global exchange clearinghouse to just a warehouse owned by a large distributor. Well, you're then transporting it from the distributor to maybe a wholesaler, and then from a wholesaler's warehouse to a retail establishment, right, or to an online establishment, and then ships it to you. So shipping costs, as you fractionate it, as you divide that 1,000 ounce bar, well, every ounce that you go and ship is going to have an additional cost, and that cost is going to be higher with the lesser amount that you ship. You guys know this. If you go out and you try to get 1 ounce of silver, they're going to make you pay $5-10 in shipping, right? So your premium on just from that, just in that transaction, the premium is going to be very high. Yeah. And of course, all the smart stackers out there know that you at least buy it by usually the tube, or you get it by 20 or 100 ounces at a time. So in addition to manufacturing and transportation, that leads us to the coin shops. Anybody who's involved in any transactions in any industry, including in gold and silver bullion, they have to have the bid-ask spread. They live on that, right? So, just to take a coin shop example, they have to pay their employees if they have any. They have to keep the lights on. They have to rent the space, or if they own it, they have to pay taxes on it, property taxes. They have to pay business taxes, usually licenses to be in operation. There are a lot of costs that have to be paid by coin shop dealers that are reflected in the price as well. And the same thing can be said for wholesalers, right? The last major factor to affect the premium price that I observe is also simple supply and demand, right? So we kind of covered that a little bit with divisibility. For example, people would prefer to have a 1 ounce product of usually gold and silver over a 1,000 ounce product, right? And it's not really affordable for most people. But on top of that, there's preference even between identically weighted products. So for example, everyone knows about this example, American Silver Eagles, right? They're currently spot prices around $24 silver. American Silver Eagles are trading, it's hard to get them for less than $36 to $38 an ounce, right? That's a massive premium. I think about 70-80%, right? Whereas you can get, a Britannia, which is a 1 ounce government minted coin, you can get that for about $3 or $4 over spot, rather than 12 or 14, right? That's a very dramatic example. Usually we don't see the premiums fluctuate that much, but what does that price tell us? That price tells us that individuals, probably largely in America, but possibly throughout the world, are gravitating toward having American silver. Sorry. It tells us that citizens throughout the world, people throughout the world, whether they're Americans, and I think some of them are international, they're gravitating toward American Silver Eagles. For whatever reason, I'm not really clear. I think they feel like it's less likely to be manipulated by the government or confiscated. They do have a pretty good reputation. But what amazes me is that people are willing to pay so much of a premium just to have American minted silver. That's crazy to me. Bullion grade silver, nothing numismatic. We're not talking about, special first strikes or anything like that. We're just talking about simple bullion grade, investment grade bullion. So that's one example where supply and demand can be a big factor. And one thing that it could be a factor in too is, the condition of the coin. Mint conditions, people prefer to get it in mint condition versus what they call cull silver, right? Cull silver, I don't think there's a lot of it around these days, but when it would sell on the open market, it would sell for very little over spot, Whereas, let's say you could get cull silver for about 50 cents over spot per ounce of silver, even when you're paying about $2 or $3 to get a freshly minted coin. And that's just preference, right? Because people will pay more for things they like better. Yeah. So those are the factors that go into the premium cost.
So sometimes we see, for example, last year we went to a coin shop and I think you bought a Perth Mint gold bar. At the time, the price of gold was about $1,800. It was a little bit deflated. It had been going down a little bit in price.
Mm-hmm.
But when we went in, the premium was about $100. I think you paid about $1,900 for it.
Yeah.
And the dealer had told us that the premiums were rising at the time because demand was so high.
Right.
So I think what confuses me is that we can have real world demand increasing and the premiums therefore increasing.
Mm-hmm.
Meanwhile, the spot price is decreasing.
Yeah.
And that does not make sense to me. How you can have real world demand going up, but the spot price not reflecting that.
Sure, yeah. That's an easy question to answer. And I understand that it seems kind of counterintuitive. The ultimate reason for that is those 100 ounce bars of gold have to be refined into 1 ounce product. And yeah, there's an energy cost to that, there's an employment cost to that, there's a cost to the refinery itself. But refineries could be stretched to their capacity of production. And without significant additional capital investment, which apparently some mints and refineries are unwilling to make, at least for periods of time, you can have situations where they're stretched to capacity. They can no longer refine those big 100 ounce bars down to little 1 ounce bars. And so they can only put so much product on the market. Mm-hmm. And when there's only so much 1 ounce product on the market, just like with any other thing with supply and demand or any other situation, if there's an increase in demand for 1 ounce bars among retail investors and there's a static supply that can't really change, it's sort of fixed in aggregate among a lot of the refiners, then there's going to be a disconnection. It's a disconnection of arbitrage. Now, ultimately, if the disconnect becomes high enough, there's going to be massive arbitrage opportunities. So let's say, for the sake of example, the spot price was $1,800, and you could only find a 1 ounce piece of gold for $3,600 or some crazy number like that. Well, what would happen? That $3,600, that's a massive price signal. And that says to all the refiners, especially if it stays persistent over time, that says to all the mints and refiners, dramatically expand production. We want more 1 ounce coins. Melt down more 100 ounce bars, hire more staff, get more crucibles, machines,
facilities, whatever.
all that stuff.
Because at that level of demand, it would be worth it to expand significantly, put serious capital expenditures.
Yep, capex for sure.
Into that as an investment,
Right.
because the profits would be so
Massive.
Yeah.
Now, I'm using a very large number to make the point obvious. In fact, such a price signal probably only needs to be about $100 or $200 over spot, sustained over time. But yeah, private mints will definitely, they'll go to the trouble sourcing material. They'll pull it off the COMEX. Usually refiners are supplying to the COMEX, but they'll pull it off the COMEX and then they'll divide it down into smaller products if they feel it's profitable or worthwhile.
But basically, right now, because we're seeing spot prices stay static, it's simply a reflection of the fact that right now these refineries are already at capacity, so they're already purchasing these large bars. If they were ordering more of them, that would bring the spot price up. But because they're at capacity, they're not ordering anymore. It's not affecting the spot price.
Don't forget, refiners both sell into the market and pull from the market.
Right.
Because they're not only refining large bars into coins, they're also refining doré, which is a mixture of gold and silver ore, or various impure or less pure gold and silver ores into 99, 3/9 fine, 4/9 fine, pure gold and silver. So keeping in mind, there's a massive arbitrage disconnect that a lot of these refiners can't easily and immediately convert the production of 100 ounce bars into 1 ounce bars. Mm-hmm. Right. And as long as that persists, you're going to see disconnects. Now, I have a question for you. Maybe you can answer it now, having discussed this. Think about this. How come the American Silver Eagle premium has remained so high for so long? It's remained at least $10 for the past year.
I suppose that $10 premium isn't enough to move the refineries to produce more.
That's one explanation. I don't think that's the answer, though.
What do you think it is?
I think it's that the United States Mint, being a government organization, doesn't have profit incentive in mind. They don't have a profit motive at all. In fact, they complain, it's a really amazing complaint, they can't get enough blanks. This is what I hear. Blanks are pre-minted rounds that are then stamped by the mint. Oh. So they're basically pre-minted discs of silver that the mint just buys and they stamped, right? So they're complaining they can't get enough blanks. Well, it seems like every other refinery and most other mints throughout the world can get blanks. How come the American Mint can't get them, right? Huh. So that's one thing. I think ultimately, though, they don't really care about making profit because they're not a profit-driven institution. If they make profit, it goes to the American government, but the people in the American government don't really care about making a profit. If they did, they wouldn't deficit spend, they wouldn't pay such large interest rates.
Why would they do that when they can just add to the debt? Hell.
Right, and of course, private citizens can't arbitrage that. Why? Because counterfeiting American coins is illegal and will go to jail. So because the American Mint is basically resting on its duff and doesn't want to produce, they're not incentivized through profit to produce more American Silver Eagles. That's why we're seeing sustained scarcity. And that's an inefficiency that you only see with governments. You don't see it with private refineries, right? Mm-hmm. You see it only with government mints that are run by the government. And that's why I think there's currently a sustained disconnect. But will that eventually go down? I don't know. If the American Mint decides to increase production, accidentally getting the answer right, or accidentally doing the right thing, that could happen. But I don't think they're incentivized to, so it probably won't happen. Maybe if a lot of people complained, I guess there might be some political pressure to produce more, but I don't know.
What do you think would happen to premiums during a period of hyperinflation?
For gold and silver premiums?
Mm-hmm.
That's an interesting question. Mike Maloney has this overall framework that I agree with. He says gold and silver will actually undergo alchemy, right? They'll turn into unaffordium and unobtainium. he puts it that way, and I like that. It's kind of funny. But let's think about this in a more nuanced sense. I think you'll be able to obtain gold or silver at a much higher price. It'll always be obtainable. If you're willing to give up your house for an ounce of gold, or let's even say an ounce of silver, yeah, you can get it. So it's never really entirely unobtainable. But consider this: if the price of gold is going up due to hyperinflation, then all the constituent costs that make up the premium are also going to go up. So, for example, the manufacturing costs, most of those are based on energy and based on employee time, right? Those manufacturing costs are also going to be going up a lot. The transportation costs will go up a lot. The demand for further divisibility will probably go up. People won't just want 1 ounce coins of gold. They'll probably want, if they can get them, 10th ounce coins of gold. So there's going to be an increase in the premiums there. The big question I ask myself is, if the price of gold goes from 2,000 an ounce to 10,000 an ounce, will the premium go from, let's say, $100 or 5%? Will it go to $10,100, or will it go to 10,000 plus 5% of 10,000, which would be $10,500?
Or more than 5%. If we have hyperinflation, isn't it possible that the percentage of the premium also rises at a higher pace?
Yeah, it could be. You're right. It could be that instead of being a 5% increase, it actually, the premium goes up, and we've already seen this a little bit, to 10%, 15%,
8
right?
10%.
I don't know. I really don't.
Yeah.
And how will that be affected in the bid ask? I really don't know. What I suspect is, well, what I almost know for certain is the constituent costs that go into the price of gold now, having a premium of $100 on, let's say, a 2,000 ounce coin, 2,000 ounce spot price, those factors will all cost more. They'll be priced higher if in an inflationary environment. So at the very least, the percentage should carry over. So it should be $10,500. Right, for the cost you're paying for, if gold rises from 2,000 an ounce to 10,000 an ounce, you should be paying at least the same percentage.
Yeah.
And as you point out, I think even higher, because if gold's going up 5 times, oil's going to go up 5 times, energy costs, people's cost of living is going to go up 5 times. All those things are going to go up together. Right now, you might argue gold might go up 6 times, the cost of living might go up 5 times or 8 times. There are going to be mismatches there, right? But in general terms, all those costs that go into the premium are going to be reflected even more in greater dollar terms in the future in a hyperinflationary environment than they are now. And then on top of that, the sort of unobtainium part, if there is a tremendous scarcity and there's a strong, robust investment or retail demand, yeah, I think the premiums can go up even higher, because of that supply-demand curve. If you have a fixed supply and you have a lot of people going to that supply, and the production isn't up significantly, and nobody's selling, then I think you can see premiums go even higher. And then there's a secondary effect to that too, which is that gold and precious metals, and there are a couple other markets that are like this, they actually violate, in the extrema, they violate the laws of supply and demand. In fact, as there's more demand, right, that causes a self-reinforcing positive feedback loop of making even more demand. Well, you see that with any kind of bubble, and most gold and silver bull markets say end in bubbles. So we can even see a situation where just the fact that the price has gone up a lot will cause a lot of demand among traders, among investors, among all kinds of people. We saw that, I think, with Bitcoin recently. There's demand, much more demand for Bitcoin just because the price moved higher. And that, I think, will also cause a lot of premiums, right? A lot of premiums to rise anyway.
Yeah.
Yep.
Kind of interesting to think about.
Well, any other questions?
I think that's basically it. I don't know if other people in the stacking community had these similar questions, but this has been quite informative for me.
Yeah, I think it's good to sit down and understand some of the fundamentals that go into determining price of gold and silver.
Yeah, well, this was an interesting and informative session of Alexis questions. And if you have any further questions or comments, feel free to leave them below.